Shelley describes herself as a green evangelist. She's with an organization called the Green Impact Exchange, which purports to deliver accountability and enable investors to be confident that companies are delivering on their promises. So let's hear about what it's all about. Thank you, Shelley.
Oops. Thank you, Nick. Thank you, Peter and team. It's a pleasure to be here, and thank you all for trudging out in this very mini snowstorm. I want to start off by saying if you guys were here yesterday, you heard a lot of exchange presentations, and you're probably thinking, oh no, another exchange. You heard about a commodity futures exchange. You heard a speaker on carbon offset exchange, and you heard a speaker on green asset exchange. Well, actually, this is entirely different. It's a equity exchange. And the Green Impact Exchange will be the first U.S. stock exchange devoted to creating a green ecosystem. It's where green-minded companies and green investors meet. So the core of our mission is really transforming investing. It's an exchange focused on the E of ESG, and it's really what investors care about in this case is the E. So by listing with GIX is making a choice about what the company wants to be measured on first and foremost. You might be thinking, well, why do we need another exchange? Well, I'm about to tell you. I'm really going to start with the state of ESG. It's time to disaggregate the E, the S, and the G. The one-size-fits-all approach is one of several root issues holding back the true potential of ESG. You guys have heard this many times about all the money flowing into ESG, and it's true, and it's quite impressive. 25 trillion has flown into ESG, and there's another 30 trillion earmarked in the next 20 years. That's a huge incentive for fund managers to create ESG-focused funds and for companies to pay attention to this because of the potential profits. And then you talk about the millennial generation. They are poised to participate in one of the greatest wealth transfers in history from the baby boomer generation. They have a greater interest in sustainability relative to their predecessors, and they're also more confident that sustainable investing can have an impact on corporate behavior. More importantly, however, they don't feel well served in the existing frameworks for what ESG has to offer. Therefore, we're proposing a new and simpler mechanism to help millennial investors figure out where to put their resources and have an impact. So let's cut to the chase. The current ESG world is in turmoil. We're thinking about green commitment all wrong. For now, it suffices to say that yes, investors are looking to, save the planet, and also companies are largely understanding that this presents a solid opportunity for profit. So therefore, the system is nominally working as it should. But I say nominally because there's friction. How do you really measure the degree to which company is doing what it says it's doing? ESG criteria is one measure to which a company can look at metrics, but it's difficult for companies to credibly prove their mettle in the E, the S, and the G. And that presents a critical problem for ESG because it can't quite deliver on its promise. How do you know if a company is walking the talk? One answer, measure everything. And when I say everything, I mean everything. MSCI, Bloomberg, et cetera, they break down each part of ESG, as you know, into specific areas of focus using a proprietary methodology to score companies along all these various dimensions. But which ESG score is correct? Which one is better? Which is right? A lot of them consider what's already been done before, but that's backward looking. And if talking about the future, companies can have these, say, goals out to 2050. That's great, but are they realistic, and what are the steps to getting there? Thus arises the inherent problem in ESG. First, it's an alphabet soup of standards and data that are diffusive and hard to get one's arms around. It obscures the difference between various dimensions. Focusing on a single dimension, in this case the E, promotes informational clarity that draws green-aligned investors. Secondly, it's not just that the E, the S, and the G are too broad. Proprietary, divergent nature of the ratings doesn't lead to consistent results. ESG ratings, on average, correlate anywhere from 40 to 60% of the time. I've even seen some as low as 14. Compare that with the credit markets. They correlate about 95 to 97% of the time. Third, we rely on third parties to do our work for us. Perhaps we just need better information from companies and more information. That's where the likes of SASB and TCFD stake their flags. They focus on data. They use a tool we're all pretty much familiar with. That's materiality. Materiality tries to identify and measure how a company is doing based upon whether criteria is material to its financial results and its operations. But it's an outside view. Which things on the outside are threatening the company's four walls, and what's the likely impact of that? The problem becomes unwieldy when you're looking at about 2,000 different variables, and it isn't the same across every company, because certain companies say, well, this variable is important to me, so I'm going to disclose this and not that. It becomes too granular. It also becomes too divorced from the context that would make it useful. The consumer of the data is forced to investigate and find the context rather than the producer of the data, the company, giving the reason why it's relevant and useful. Materiality, therefore, doesn't tell the story. As an example, one company could say, I've reduced my energy intensity by 15%, and another company could say, I've increased my energy efficiency by 15%. Is that the same thing? No. So how do we get out of this morass? Moving along the scale from data to wisdom. The assumption is when it comes to companies, we're stuck with this aggregated and amalgamated information because companies are large and it's complicated and they don't want to disaggregate and hold themselves accountable for any one realm. But that's not true, and we think there's a solution. The example is a specialized exchange. After all, an exchange is where corporate governance starts. It's a market-based answer to an ESG problem. A specialized exchange would focus on governance rather than a set of metrics. It addresses a hole in the marketplace of understanding ESG. Governance rather than a set of metrics does this. When you look at these three circles, they're the primary activities of a corporate and their primary outcomes. So first you have managing and measuring, and that addresses risk management. Then you have measuring and reporting, which results in materiality-based disclosure, and reporting and managing, which facilitates the job of your IR professionals. So where's the credible commitment? Without enforceability and accountability, ESG, despite the millions of hours spent developing and implementing metrics and frameworks and agreements and guidelines, remains a fancy set of suggestions. Oops, did I go back? Let's see here. No, I think that's okay. Okay, so sorry about that. The standards listed here focus on, oh, it is stuck. Yeah, the standards listed here focus on these primary activities, and they help to clarify the landscape. An exchange is not a new set of standards, but rather it leverages the existing work that's been done to date by the standards. We're not imposing new standards. So the importance of an exchange, there we go, drives economic revolution. So let's talk about exchanges. So the NYSE helped create the economic boom from the 1940s to the 1980s. The NASDAQ came about largely because companies couldn't meet the standards of the NYSE. They, in turn, brought about the tech economy from the 1980s to the 2020s. GIX is doing the same for green by creating the green economy boom of the future. Thinking of the logic behind this. So GIX doesn't expect only to list the traditional, quote, green companies. The old saying is you rob a bank because that's where the money is. Well, that's the same is true for brown or brown-ish industries. Most companies are in the A position in the lower left corner. Only a handful are in the B in the upper left. A company adopts green governance standards. If they adopt them initially, they'll have good green governance, but not necessarily quick sustainability improvements to show for it. It takes a long time to turn a battleship, but it starts with putting the rudder in the right position to turn. Brown companies develop really the most impactful green measures. Once a company has lived with good green governance, we expect it would move to the upper right corner. So the B companies just happen to start off in a better position, but even if they already exhibit reasonably good results in sustainability, good green governance will tend to move them both up to the upper right. So good green governance starts with 3 pillars. The first is values, focusing on leadership, starting at the board and then at the executive level through full engagement and oversight. Who's the company? What do the leaders say about it? What do they profess as its purpose? Do leaderships know who its core stakeholders are? Do they engage with them? The second is vision, set forth through goals, policies, processes. The focus is on governance here, not on metrics. It's on process and controls over outcome. Does management set goals that are consistent with their values and their stakeholder interests? Do they have a strategy for achieving those goals? And finally, the third is action, clear processes to accept and take action through implementation and alignment. How's the company doing? How does it measure its progress? Does it hold itself accountable when it's not aligned? And what are the mechanisms for getting realigned? Data and measurement fall under action, the last one. Why? Because you can learn a lot about a company just by understanding its culture and approach. The data is critically important, but only has meaning when it has context. The values and vision is what moves us to data, from data to understanding and wisdom, from that which is opaque to that which is discrete and measurable. Raw data alone with no context means nothing. It's up to the investor, who may be the least well-equipped, to tease out any understanding or wisdom from the data. A GIX listing gives reason to believe that one company is better than its competitors. So the specialized exchange allows you to focus attention on one realm over another, gives the company a meaningful way to prove it's credibly committed to change, and it gives investors a direct way to express their support for that change. It creates an accountability loop, a voluntary enforceability factor that really doesn't exist elsewhere. The current system lacks trust, probably a lot because of greenwashing, but specialized exchange brings trust back into the system. I'm not going to go through these the 6 principles under the 3 pillars, but just to emphasize that to be listed would require a certain set of standards before you list, a certain set of standards to meet within a year after listing, and then ongoing standards. We look at this as a journey, not a destination. We want short, medium, and long-term goals. You know, it's great to say you have 50 goals for 2050, but when you think about the average tenure of a CEO, it's 7 years. That's 4 CEOs from now. And just think, as an example, 4 CEOs ago at GM, the CEO said, scrap the electric car. So what we're saying is here, we're passing the baton. We're not expecting to cross the finish line with the current CEO. Some of you might say, well, why can't I just invest in an index? Why do I need an exchange? So the difference with that approach is that the company becomes a passive participant. they're involuntarily in a black box. They end up getting the score. They don't know how, they didn't ask for it, then it changes, then they're dropped from an index. You know, when you list on the GIX, it becomes active, voluntary, and contractual. So there's more heft and more commitment behind statements of companies that want to hold itself accountable. So a specialized exchange does several things. It acts as a third-party validator. A company must adopt standards that embody governance principles. If they don't, they're at the risk of delisting. The beauty of this is that it makes a choice, that the company communicates it's holding itself to a higher standard. It's willing to risk being delisted. That's a publicly reportable event. An exchange doesn't have a choice. It too is regulated. And if it doesn't enforce its listing rules, the SEC can sanction it as well. Investors can rely on the exchange as a marker of which companies are credibly committed. It simplifies the investment selection process. The exchange provides investors with a way to signal their approval or disapproval of a company's green commitment. So sending an order through a dedicated green venue suggests that the investor has what we call green intent, communicating something fundamental to the market that doesn't exist today. It allows them to prove their credibility that they're doing what they're saying. A lot of companies are inherently in brown businesses that never can be looked at as green, no matter how good they are and green they are, and they don't have a way of expressing that. So, bottom line, exchanges exist to bring structure, transparency, credibility, and accountability to the capital markets. The green economy desperately needs an exchange for all these reasons. It's a demand-based exchange. The green movement is simply too big not to have an exchange dedicated to its future. So please, I would love to hear your feedback. We are not yet formed. We're looking to probably become an official exchange in Q1 of 2024. So I would love your questions, your comments, your insight. So thank you very much. And questions?
Thank you. My name is Elsie Mayo, and my company is Humanity, Inc. Thank you. Thank you, thank you, thank you. What you're doing, I don't know about forming an exchange, but what I do know is that for 20 years, the sustainability movement has had no accountability, which is part of the reason why we're here in a pressure cooker trying to figure out how to meet net zero. So the notion of accountability, filling the accountability gap is brilliant. I don't know, as I said, if exchange is the way to go, but I hope so. So what this, if I'm hearing correctly, would do would be to legitimize companies that are deliberately creating environmental value.
That's correct. Legitimizing it, going through all of the stages of measuring it, reporting it, communicating it, being transparent. So we are not so focused on, did you meet your target for 2030? And if you didn't, sorry, you're delisted. Not at all. It's really about, have you made the committed efforts to get where you're getting? And if, for example, some exterior outside fact, some idiosyncratic event happens to prevent you from meeting that goal, well, it's not necessarily the company's fault, but if they did everything in their power to get to where they expected to, that's all right.
Right. So we're still talking in terms of managing risk, environmental risk factors. What I'm seeing here is the potential to legitimize those who would actually stop looking at E as a risk and see it as an opportunity to generate well-being for the living system.
Mm-hmm. Absolutely, I agree with you, and that's why we emphasize that we want to talk to brown companies, green companies, purple companies.
Okay, just a couple of things. So yeah, it's a way to bring the board into the conversation of accountability and governance. right? It's a way to protect those leaders who really would like to do this, but say, the financial markets will kill me, right? Because I can't, they won't give, they're not patient enough. And those are, and you see the potential there in companies that are flocking to B Corps. Because being a B Corp or a benefit corporation legitimizes their intention to contribute to more than just share owners. And the third is that it's a way to capture the value add of actually being green, rather than treat it as a risk to avoid. So thanks so much.
Thank you, thank you. And I wanted to mention one thing. Oh, I ran out of time, but I'll make this very quick. We are a B Corp as well, a benefit corp. And for those of you who don't know, exchanges make money 3 ways: listing fees, trading, and data. We plan on giving back 1% of all of those to green initiatives, and we're the first exchange to be doing that. So,
Thank you both.
thank you.